Thank you, Sathani, and very good morning, Dr. Sa, Dr. Visna. Sawadi Kap, Arun Susday, professors, associate professors, doctors, ladies and gentlemen, and all my beloved classmates. Before I go into this, maybe I can give some input regarding to the comment from Dr. Chris regarding to the pestle analysis, which is very important, that our presenter have been presenting earlier. In some business, they have to include the L and E also on the legal and environmental impact. And regarding to the political, I agree with Dr. Chris that at this moment we are in the uncertainty of global economic political agenda. So some of the manufacturing, they are playing in all these uncertainties. For example, the manufacturing in China, because of the tariff, they are moving to other areas, including some country in Southeast Asia, like Vietnam, Cambodia, Thailand, all this area, in order to leverage and in order to take chance on this uncertainty. However, their investment perspective also different in this uncertainty political environment. Thank you, Dr. Chris, for the input. So now I would like to move into my subject on the capital budgeting and investment evaluation. For the capital budgeting and investment evaluation, why it is important for the business? It is a strategic financial management that providing the organization with systematic approach to evaluate and select which project for the long-term investment project of the organization, and they have to consider about the fixed asset investment and resources allocation as well. Throughout this presentation, we will explore the fundamental of principle of capital budgeting, examine various evaluation methodology, and also sensitivity analysis, as well as the risk assessment that contribute to the sound investment decision. Understanding this concept is very essential for the financial professional seeking to maximize the return while maintaining and aligning the organization objective. To understand about what is the capital budgeting, let's define the definition. It is the process of evaluating and selecting long-term investment projects to maximize shareholders' value and don't forget to align with the strategic objective of the organization. What is the purpose of doing capital budgeting is to make the informed decision regarding to the fixed asset investment, resources allocation, and financial sustainability of the organization. What significantly regarding to the capital budgeting is it is direct impact to the company long-term financial health, competitive positioning, and generate sustainable returns of the organization. The capital budgeting represent a critical financial discipline that guide organization to determine which project deserve priority and have to mitigate the risk, identify the opportunity, and creating the value not only for the project, but for the organization as a whole. Let's see what is the capital budgeting process. There are 5 processes in this capital budgeting process. Number 1 is to identify the investment opportunity, which we have to discover the potential project that align with the strategic goal of the company and market opportunities. This involves comprehensive market research that we have to do in that specific project, and also the internal capability assessment, whether the company is capable and the team is capable to handle that project or not. Number 2 is to establish the forecast that expected cash flow in and cash flow out of the project, including the initial costs, operating expense that we need to study the project revenue over the investment life cycle, whether it is profitable for the company or not. Number 3 is to evaluate investment options, that we have to apply the financial metric and analysis technique to assess each viable project and it is profitable or not, also checking about the risk profile against the established criteria. Number 4 is to select the investment project that optimal returns and aligning with the strategic objective. If it is not aligning with the strategic objective of the company, that is not a good project, even it is giving the financial return. And last but not least of the process, implement the project and monitor it. Keep monitor it continuously, tracking the performance against the project, making the adjustment if necessary, and ensure the expected outcome have been met. Investment valuation methodology. There are 4 investment valuation methodology that we need to consider for the investment of the project. Number 1 is how long that the payback period, the time required to recover the initial investment from the cash flow in. This is to calculate but cannot ignore the time value of money for the cash flow beyond the payback period. Number 2, we need to think about the net present value called NPV. That net present value is the future cash flow in of this project, whether it is at the end of the project life cycle, the company and the project will make the money or not. Number 3 is on the internal rate of return, that we need to annualize the rate of return. If the internal rate of return, so-called as IRR, is high, there is good investment opportunity in terms of financial investment. And last but not least is the profitability index. We need to calculate on the PI whether the project is good return for the investment or not of this project, and it is creating the value for the company or not. If the profitability index is greater than 1, which means at the end of the at the end of the project cycle, it will generate more value for the company. Let's see some example presenting on the number on the net present value analysis. Let's say the investment is 2.1 million as initial investment that we need to pay out as a capital investment in this project, and the future cash flow in, the value is 3.5 millions, that come up with the net present value of 1.4 million, which is a good project that at the end of the project life cycle, we will generate more money than our initial investment. And calculating about the profitability index is 1.67 is very good project in terms of financials perspective of the project and the value for the company. So the NPV is a standard for capital budgeting, accounting for the time value and the money through the discounting rate. The example above is demonstrated. It is a very good financial return, especially on the NPV, that make profitable index is right high. 1.67 is a good project to invest. The strength of NPV analysis is to approach the evaluation, incorporated, but we have to incorporate it all the cash flow in projection as estimating in this project life cycle. Then we can find out all this number, whether it is opportunity, cost of capital, and creating value for the company or not. However, we need to do the risk assessment as well. Let's talk about the sensitivity analysis techniques. We define 4 analysis techniques. One is the scenario analysis that we evaluate the project performance under different scenario. One is the normal best case scenario. The other one is the worst case scenario. And another one is the best case scenario, calculating the NPV and IRR for each situation. Then we can make a better decision. Also defining the break-even point for the project. What is the minimum value of the critical valuation in terms of sales volume, in terms of price, how we can make a break-even in this project. Then we have to do the spider diagram in order to identify the various input of the NPV simulation that identify which variable is good and what is the great impact on the project success. Then we do the simulation analysis. The simulation analysis is the computer generating the random value in order to make decision on various across different iteration, creating profitability distribution for potential outcome. Then we can make decision on that project. The sensitivity analysis is very essential for identify the key driver of the project profitability and to understanding the source of uncertainty. By stimulating this, we will have the input assumption for various scenario and also financial analysis that can determine various significant influence investment outcome and also the investment outcome. However, in this all this analysis, we have to incorporate the risk assessment as well. The risk assessment, we have 3 steps. One is to identify the risk, identify all potential risks that affect the project cash flow, and including the market risk, operational risk, financial risk, and regulatory risk as well. By doing the comprehensive risk identification, it has to have the input from all the cross-functional team and internal and external factor as well to identify into the risk factor. The second one is risk quantification. Once we identify it, the risk must be quantified for that project. That we need to think about the impact and the return. To quantify the risk is to calculating the expected value. Some techniques in order to use this like statistic techniques such as Monte Carlo simulation can generate profitability distribution of the NPV and IRR. What is the Monte Carlo simulation? The key of this Monte Carlo simulation is to select the random sample. Second one is to find the multiple outcomes. The third one is probability distribution in terms of the NPV and IRR. And the number 4 is to aggregate all those results in order to make the decision. The last step of a risk assessment is the risk integration. This is the final step to incorporate the risk assessment in the capital budgeting for making decision process, adjusting the discounted rate in the financial budgeting, and the risk adjusted budget allow for more meaningful comparison between the project, whether we want to invest in project A or project B or project C is based on the risk assessment as well, rather than only financials. The effective risk assessment would enable the organization to make informed decisions on the investment and to mitigate the risk of the project investment and preventing the overconfidence Sometimes we are overconfident in terms of financials numbers, but when we incorporate the risk into the project, we will consider another outcome that encourage the appropriate risk management strategy into the business process of capital investment. In conclusion, for this module is the key takeaway and strategic implication. Number one is on the strategic alignment. The effective capital budgeting must ensure investment are supporting the long-term objective of the company. Without supporting the long-term objective of the company, it will be having the risk in the company as a whole. Number two is to make the informed decision and optimal capital allocation. Number three, on the risk management. The risk management assessment identify, quantify, and address investment uncertainties. And last but not least is the value maximization that ensure that shareholder return and organization sustainability in terms of financial return. The capital budgeting that present is very critical discipline for the financial professional, providing systematic framework for evaluating investment opportunity and allocating resources. By employing all these rigorous analytical method incorporated, the risk assessment organization can maximize return and also align with the strategic objective. The effective capital budgeting process have to combine quantitative technique and qualitative consideration. Recognizing the numbers alone are not captures all the relevant factors of the organization and decision making. This is a conclusion of my module 1. So